PE ratio. Hello value viewers, I'm Ravindra. Today, we're on a journey to uncover the secrets of professional investors. In the world of finance, investors have been using various tools and metrics to make informed decisions. Among these, one stands out for its simplicity and effectiveness: the PE ratio, also known as the price-to-earnings ratio. But what is this PE ratio that even the most seasoned investors swear by? Why is it considered a secret weapon in the investing world? And how does it help investors navigate the complex labyrinth of the financial market? In the next few scenes, we will unravel these mysteries. We will examine the power of the PE ratio, demystify it for you, and recap its importance in the world of investing. So buckle up as we embark on this insightful journey to unlock the professional investor's secret. The PE ratio. Let's get started. Welcome to Value View. I'm Ravindra. Today we're going to delve into the professional investor's secret, the PE ratio. Investment decisions are akin to navigating complex labyrinth. One wrong turn and you might end up losing a significant chunk of your hard-earned money. The PE ratio, or price-to-earnings ratio, is a compass guiding investors through this maze. The PE ratio is a simple yet powerful tool in the world of investing. It's like the heartbeat of a company, giving us a snapshot of its financial health. The price-to-earnings (PPE) ratio is a fundamental metric that not only assesses the current state, but also hints at the future. By comparing a company's market value per share to its earnings per share, the PE ratio tells us about market expectations for future earnings. A high PE ratio suggests optimism and the anticipation of robust future growth, while a low PE ratio may indicate more conservative expectations. In this way, the PE ratio serves as a powerful tool for investors, offering both a current assessment and a glimpse into what the future might hold us discern whether a stock is overvalued or undervalued. It's a beacon of light in the often murky waters of investment decisions, helping us steer clear of potential pitfalls and towards more promising prospects. But let's remember, just like a compass, the PE ratio isn't a map. It doesn't dictate which path to take, but rather it provides vital information to help us our own course. Just like a compass can't tell you where to go, but can show you the directions, the PE ratio doesn't dictate investment decisions, but provides vital information to guide them. Imagine walking into a supermarket to buy oranges. You see two similar-looking baskets, one priced at $10 and the other at $5. Which one would you choose? The answer seems obvious, doesn't it? Now think of the supermarket as the stock market, the baskets of oranges as companies, and the price tags as the price-to-earnings, or PE ratio. In an ideal world, just like you'd choose the cheaper basket of oranges, you'd choose a company with a lower PE ratio, all other things being equal. This is because a lower PE ratio could mean that the company's stock is priced reasonably compared to its earnings. But here's the twist. A higher PE ratio doesn't necessarily mean bad news. It could indicate that investors are expecting higher earnings growth in the future from the company. They're willing to pay a premium today for potential profits tomorrow. Like the price tag on the basket of oranges, the PE ratio is a simple but powerful indicator of a company's value. Navigating the investment labyrinth becomes easier when you know how to use the PE ratio as your compass. Example 1. Comparing two stocks. Let's compare two hypothetical stocks, Company X and Company Y. Company X has a PE ratio of 30. Company Y has a PE ratio of 10. Initial analysis. Company X's PE ratio of 30 suggests that investors are willing to pay $30 for every $1 of the company's earnings. This indicates higher expectations for future earnings growth. Investors are optimistic about the company's prospects. Company Y's PE ratio of 10 implies that investors are paying $10 for every $1 of earnings. This may indicate that the market has more modest expectations for future growth. Scenario 1. 1 year later. After 1 year, both companies report their earnings and their PE ratios change. Company X's PE ratio remains at 30. Company-wise PE ratio increases to 15. Analysis after 1 year. Company X maintains its high PE ratio, which means that investors' expectations for future earnings growth are still strong. The stock continues to be perceived as having significant growth potential. Company-wise PE ratio has increased, indicating that investors have become more optimistic about the company's future earnings. This suggests that the company might be performing better than expected. Higher PE ratio implies more expectations. A higher PE ratio generally suggests that the market expects the company to deliver substantial earnings growth in the future. However, this also means that the stock is more susceptible to market sentiment and investor expectations. If the company fails to meet these high expectations, the stock may experience higher volatility. Implications for volatility. Stocks with higher PE ratios are often more volatile because they have a lot of baked-in expectations. If the company's actual earnings fall short of these high expectations, investors may react by selling the stock, causing its price to drop more significantly. Stocks with lower PE ratios may be less volatile because there are fewer elevated expectations. If the company's earnings exceed these more modest expectations, it can lead to positive surprises, potentially boosting the stock's price. In summary, the PE ratio is a valuable tool for comparing stocks and assessing market expectations. A higher PE ratio suggests higher expectations for future growth, which can lead to increased volatility if those expectations are not met. Conversely, a lower PE ratio implies more conservative expectations, potentially resulting in lower volatility or positive surprises if the company performs better than anticipated. It's important for investors to consider a stock's PE ratio within the context of its industry and growth prospects. But it's not just about comparison. The PE ratio also serves as a crystal ball, allowing us to peek into the future earnings expectations of a company. A high PE ratio could indicate that investors are expecting higher future earnings, while a low PE ratio might suggest the opposite. But remember, like any tool, the PE ratio has its limitations. It should be used in conjunction with other financial indicators to provide a comprehensive view of a company's worth. Remember, the PE ratio is just one tool in your investment toolkit. Use it wisely, and it can guide you to lucrative investment decisions.